on Donald Trump and the possible broader effect on equities. We're joined by Mark Luschini, Chief Investment Strategist at Janney Montgomery Scott. Thank you very much. Off the top, do you see any kind of a direct read-through for investors here from the Trump verdict?
Certainly not at the moment. I think investors' eyes are more focused on the release that came out this morning, particularly as it relates to the Fed's favorite gauge of inflation, the personal consumption expenditure index, which was spot on expectations, showed a slowdown on a month-over-month basis. And importantly, reading through that number, the core services PCE ex housing or super core PCE also cooled on a month-over-month basis, which is something that was noted by Jay Powell in the past as indicative of where wage gains may manifest in a way that would be troubling for Fed officials. But it's cooperating, at least in this month's reading, and that's what the market seems to be queuing on as futures here look like they're ready to pop.
Looking at the US dollar, marginally lower, as you might expect if there are increased expectations for a rate cut eventually.
Most definitely. Weakening a little bit today, still 104 handle on the Dixie, but nonetheless, if you also look at expectations in the futures market with regard to rate cuts, moved up a little bit, about 1.5 between now and year end, suggesting that certainly one seems to be on the table, possibly two later in the fourth quarter, but nonetheless, not so much so as to take them completely off the table, but certainly today's reading is a reason to give perhaps more confidence to Fed officials that inflation is, in fact, on the proper glide path to get down to their target.
What about tech? Some darlings have disappointed with their outlook. For example, Palo Alto Networks, I'm thinking about. What's your strategy broadly when it comes to the big tech stocks?
Well, certainly they have. We've had a couple of software stocks, Salesforce being the poster child of that sell-off rather unmercifully yesterday. If you look at the tech sector at large, I mean, it's still a great investable space to be in. I mean, software as a service and just more even broadly AI and all that will infiltrate into corporate profits on a go forward makes investors, I think, continue to bid on them on sell-offs like we saw yesterday. Having said that, valuations are not inexpensive. So when companies announce, like they've done here in the last couple of days, news that wasn't necessarily bad, just didn't exceed elevated expectations, they're ripe for significant pullbacks. But more often than not, that served as an opportunity to step in and bid those equities back up. And I think that's what we're seeing again here, at least early on today. And I think on a go-forward basis, these are still remarkably healthy companies with great free cash flow and iconic brands. And so for investors over the long term, they continue to be an opportune place to have capital. What
about the big one, though? The big N, NVIDIA, is it too rich for your blood right now?
Well, certainly it would seem to be, and that's defied gravitational pull every time somebody has said that. Having said that, obviously, unless capitalism is dead, it does invite competition. And at some point, these valuations, which are exceedingly stretched, won't necessarily mean the demise of NVIDIA, but it'll certainly probably cool its rally to some degree. And I think it is ripe for a pullback that could be quite significant. Maybe, again, opportunistic, but again, ripe for a measured pullback.
As you know, oil and gas is a big chunk of our market in Canada, and you are positive on energy.
We are. I mean, in general, we still think the demand for energy has been quite healthy globally. We're seeing some pickup in economic activity outside the United States, which is certainly encouraging. In addition to that, obviously, the supply constraint applied by OPEC Plus has been remarkably stout. And of course, they'll be meeting this weekend, expecting no change to increases in supply coming out of OPEC Plus. And so as a consequence, we continue to like oil prices elevated at these levels or potentially a little bit higher on a geopolitical event. And as a consequence, we think that bodes well for the profitability of energy companies in the aggregate.
Thank you very much indeed for joining